A better than expected growth outcome in the non-oil sector pushed Nigeria's full-year GDP growth to 3.4% in the fourth quarter, but that didn't quite impact the equities markets, which traded rather mixed. Dare Fajimolu, the Chief Research Officer at Blue Vertex, joins me to discuss the markets. Thanks so much, Dare, for your time. So yes, the fourth quarter numbers are certainly looking at what happened several months ago. But in your view, what do they tell us about what is happening next? Because as I mentioned earlier, they were better than expected. So shouldn't the market have, would you say the market had already priced in that performance, or do you think that the market is just slow to react to it?
Thank you for having me, Odi. So essentially, like you said, it's something that has happened. So this is the lagging data. So that has already been factored in a way, reflected. If you remember that 2000 year-on-year performance for the equities market was about 6% as of December 2021. So that already reflected the performance of the GDP as at that time. But of course, positive growth rates is it can be a guidance to what to expect in the coming quarter. But 2022 has its own peculiarities because it's a pre-election year where a lot of political movements are going on or will soon intensify as we approach the election period. So the outlook for 2022 in that context perhaps outweighs the positive expectation, the positive responses that investors would have otherwise given to these positive developments in terms of the GDP growth rate.
But the market obviously has started the year very well, but perhaps more precisely, we should say it started January very well, because so far this month is only up about 1% compared to over 9% in January. What do you make of the slowdown, and do you think it's just a matter of time for the market to begin to move up again? Perhaps the expectations of full-year results could be the trigger.
Yes, so expectations of full-year results could be a trigger. And of course, now that we have a lot of domestic investors in the market, domestic investors are known to be positively disposed to corporate actions like dividends, bonus, and the rest. So once we have full-year results coming in with those kind of corporate actions, we're expecting the markets to respond positively to that. However, as the year proceeds, then the overhang of the election, the preparation for the election is going to have more influence on the market, because it is certain that a new administration is coming in. This is the end of the second tenure of President Muhammadu Buhari's administration. So definitely a new administration is coming in, and that means another fiscal policies are going to be introduced. Another set of fiscal policies are going to be introduced into the market space. And so investors will be very alert to that in terms of conversations that are being made by likely flag bearers of different political parties and so on. And so that as the year proceeds, that's something that we're going to look out for. But definitely in the short term, results, our corporate actions will influence the market in the shorter term.
There's almost a consensus amongst analysts that yields are going to rise this year for two reasons. One, high inflation, and then second, because of the prospect of further borrowing from the government. But so far, I'm looking at the activity in the fixed income markets. Yields have actually dropped over the last few weeks. Do you still share that expectation that yields are going to move higher? And if so, how do you see that impacting the market's rally for the equity markets?
I expect yields to move higher. One other factor that can drive that is expectation. So in terms of for the equity market is definitely it's not guaranteed. So it depends on a lot of catalysts and a lot of triggers that can come into play. But in fixed income market, once you have an instrument, it is fixed income. So that is definitely going to attract a lot of investors because of the high level of uncertainty that we're going to enter into as the year proceeds. So that's going to help the yields to go up, and definitely will make it more attractive it will make the fixed income space more attractive than the equity market.
So ahead of that earnings season, which companies do you like? What are your top picks at this point?
So in terms of earnings seasons, we look at companies that have been consistent with dividend payment, things in the like tier one banks especially, and then some other companies that the consumer goods are. It's quite mixed because of different challenges. There are a lot of conversations about subsidy removal, a lot of about both in the electricity space and the oil space. But in terms of the other more stable sectors like the financial services, the banking that I just mentioned, that seems to be somewhere that investors will want to position in.
All right. And finally, I just wanted to get your perspective on the macro story. Obviously, we're talking about the GDP numbers for the first quarter. What concerns you the most in terms of the macro story moving forward that you think potentially could be a risk to the downside for equities moving forward?
It's still the political space because investors don't like uncertainties. Now, for the fact that a new administration is coming in and we're going to see a new set of fiscal policies, that is something that investors will be a little bit wary about. So as that proceeds, until we are clear about who the flag bearers will be for the specific, for the political parties and their likely agenda and so on, that is going to be something that investors will be a little bit jittery about. So that's one thing that I think can negatively affect the equity space.